Okay, we're going to talk a little bit about expanding access to financial services. And I suppose the key here is that one of the great oft-touted benefits of financial technology is it's going to improve the market, it's going to improve the potential addressable market. Technology allows everybody to easily access new products. But is that really the case? Does technology really enable access? Or is it really just a kind of one of those disruptive ideas? Well, we're going to explore it. We've got a fantastic panel here lined up, just waiting for Ridian to appear, wherever Ridian is. Here he is. I can see him coming over now. Hello, Ridian. Okay, Rod, James, Didier, Ridian. Frederick, as I said, isn't going to be here from United Credit. I'm afraid we can, hello, Ridian, we can blame strikes in France at the moment. Anyway, so, gentlemen, thank you very much for coming along. Look, is fintech really about searching for underserved customers, or is it really just about catering to traditional customers with a kind of jazzy new interface, you know? So is it really trying to get to people who are underserved by the market, or is it just all technology hype? I'm being a bit cynical, but who wants to go first? Go on. Iridium.
I think one thing that's underestimated is how much people tend to focus on the borrower side as underserved, because that traditionally has been an area that's either underserved or just not particularly kind of salubrious, and therefore perhaps underserved in terms of in the light, but in the dark I think it gets served. But I think, and I'll come back to that point because it sounds a bit sort of sinister, but I think the investor side, I think, is often underestimated in terms of how difficult it is for normal, everyday investors to access certain elements of financial services. So there is an access on the investor side as well as the borrower side. And I think that is an area where peer-to-peer lending is actually doing some good, because it is delivering a new form of yield, a new asset class to investors who previously could only access that through other means.
And you're right, because traditionally, if you look at it from an investment point of view, if you've got spare cash sitting around, I have to go to a brokerage account, to use the American expression, and open up something that deals in bonds and shares, and that usually has tax wrappers associated it. You go to a high street bank, you know, and you have to go into a branch to open something, or you go via independent financial advisor. It's all platform and wrapper orientated. Whereas actually, I suppose what you're saying is that we now have a multiplicity of different access routes in.
Absolutely, and the asset class of loans, which Samir was talking about, and I'm sure we'll talk about a lot today, has suddenly been opened up.
Yeah.
So as an investor, you can access that asset class, and I think that's probably the single biggest change that's happened in peer-to-peer lending, as much as the innovation on the borrower side.
I mean, I would concur with that. At the same time, we also, need to realize that when we look at Zopa, when we set out, back in 2005, it was really about delivering better value, through great customer experience for both sides of the platform, right? So not only for lenders, but also for borrowers, right? And enable them to, access cheaper finance in completely online way that at the time was quite radical. Even still today, you have still lots of incumbent banks where you need to submit things through the post. Let's also say that, consumer lending outside of mortgages today in the UK is about 200 billion, right? So every time you save 1% to the customer, that means you put back, 2 billion in the customer's pocket, right? So it's huge savings that we've managed to create for UK consumers.
Because Zopa's been around for the longest period of time, I think, of anybody here, actually. I think that's probably right, yeah. You must have done some analysis on your customers. So let's look at the two sets of customers in turn. So let's look at the lenders, the investors. By and large, your analysis, because you've obviously done a deep dive into this kind of stuff, do you find that most of them are they new to peer-to-peer funding first, or peer-to-peer finances? Are they new to it? And then in addition, are they using money that they would possibly have once used for a savings account, like an ISA account, or is it coming out of an investment pool? Maybe they had their broker. You understand what I'm sort of asking. You must know where your lenders are bringing their money in from.
Absolutely. So, Zopa kind of invented the whole marketplace lending concept, right? I mean, that's, Giles and the guy are the reason why we are here today. To answer your specific question, we see people that have, used different platforms before, but they realize that, Zopa, has been there for a long time. That's got a very strong track record, including during the financial crisis. So we've got people that, are new to the whole marketplace lending, investment.
Are they the majority, or are they switchers from other kind of peer-to-peer lenders?
At the end of the day, different investors will have different risk and rewards target, right? And some will say, they are more interested in having lots of platforms so that they diversify their risk that way. Others will want to only have exposure to consumer lending like we do. So there's really a wide array of investors out there, and depending on their circumstances, they will choose the platforms that are best for them.
James, what about your offer? Do you think that you are serving a new set of customers, or do you think that you're sort of super serving an existing set of maybe investors, but who've just chosen to redeploy their capital or something else?
So I'm slightly different to these guys because I'm the equity side. There's a couple of things I say just on these. So I think Fintech can help better serve underserved customers. That's clear. But I think actually what Fintech should do is better serve its customers. I mean, we're all running platforms, and to me, part of Fintech and everything that it brings is its ability to give customers a much better experience and a much more smooth experience. So I think I'd say that. And so we try and do both. I mean, our customers... So we have two, you're right. We have customers that are trying to raise equity through the platform, and then we have our investor base. I think in terms of companies that are trying to raise finance, in equities and particularly we're in scale-up equity, that is a badly underserved part of the market. I mean, venture is a pretty underserved part of the market. There's a lot of government initiatives at the minute to try and drive more money into scale-up funding and growth. But I think Fintech and platforms like us can help in that. I'd say our investors, actually, in the main, they're high net worths. This is giving them access to an asset class that they probably haven't had.
I was about to say, before you guys came along, what were they doing? I mean,
they do it in a
not just you, but generally crowdfunding.
I think what have we tried to do? We've tried to professionalise it and bring structure to it. So there's always been angel investors. There's schemes like EIS. There's
but the angel organisers, they're quite episodic, quite, there depends on angel groups,
fragmented,
very localised.
What we've tried to do, unlike crowdfunding, is professionalise all of that. So we've tried to say we will go out and do the role of a venture capital fund, and we'll give you access to that skill set, but you can do it and make your own investment judgment through the platform from as little as £1,000. Whereas actually, if you wanted to get access to a venture fund, you probably have to invest north of $250,000 to get access to those types of businesses.
Rod, actually, just looking at LendInvest, you probably actually, as a category, I don't really think in the retail market, you had the Montello fund, didn't you? But it didn't really even exist from a retail investor point of view. I don't think that's unfair. I don't remember 5 or 6 or 7 or 8 years ago you being able to, frankly, invest in lending to property, could you? So you have actually, in your area, invented a whole new asset class.
That's exactly right. And if you think about LendInvest is a platform for property finance. If you think about property finance, traditionally real estate loans would have been sold through securitization markets, would have been accessed by banks and institutions.
Very institutional.
Today an investor can acquire a bond, invest in our loans, and have exposure to a portfolio of bridging loans. And buy that through an ISA. So it's we think we have opened up on the investor side what was a closed asset class to a much broader range of investors. But also on the we talked a bit about on the lending side. Go back to the original question, which was whether or not we're opening up to new customers, or we're creating a better experience. I think the answer is both. So if you look on the lending side, we have both loans for property developers as well as buy-to-let investors. If you look at the property development side, That's a hugely underserved part of the lending market.
Still, do you think so?
Still by the banks. And it really is the alternative lenders that have stepped in and provided finance to that space.
Just to understand, why is that, do you think? Is it just too risky?
Well, it's bank regulation. Yeah. So if you look
too risky for the banks, maybe.
Well, I think there's clearly real estate loans were a big part of what went wrong in the crisis, and I think there's been a regulation that has come in that's probably overshot and potentially overshot the capital requirements that are made of banks, particularly in relation to property development loans. And as a consequence, it's pretty inefficient for banks to provide property development loans. Alternative lenders have stepped in and are providing finance there. So in that respect, we are providing an underserved customer. On the buy-to-let side, that's an incredibly competitive space.
Oh, so it's not exactly, it's not served, it's very served.
Yeah, it's a very, very competitive space. And actually what we're doing on the buy-to-let side is all about creating technology to make the broker and borrower's journey more efficient and better.
So there's a lot of elements to this. It's about some markets that are underserved. There's some markets that are served where you can have technology to better serve them. Let's just break that apart and let's just free for all. And please do ask questions as we go along. Let's still look at the underserved. There are some underserved markets because, with all due respect, by and large, you tend to focus, most of you, on wealthier clients, wealthier investors. More prime borrowers even. I think that's fair to say. You do go with prime. Now, there is that, I mean, Americans use the word subprime, but it gets the wrong term. But below prime, or even quite a bit below prime in loan. Now, that market's not actually been terrifically well served by online lenders. I think it's fair to say both of you guys are fairly prime-ish, yeah. But why is that? Because presumably I was expecting that market to be a bit better served. I was expecting a lot more people to come along and say, hey, we're a rival to the credit unions. Not that we have many in the UK, but...
I think that's a convenient misconception about peer-to-peer lending, in that I think, certainly at Ratesetter, we have deliberately, openly, proudly, and other things that are necessary to justify such activity, targeted a portfolio of prime, near prime, subprime, and the reason for that is that it's just economics tell you that is necessary in order to gain a balanced portfolio of exposures and loans for our investors. So, and I think that anyone who says that that's not the case on other scaling peer-to-peer platforms is huddling towards a brand perception, which I think is a little bit wrong, actually, because I think that, and it's so long as you are the risk of the different markets is priced correctly, then of course it all is fine. And obviously, so long as all the categories of borrowers are treated and with the same respect and so forth, so long as there's a conduct, one takes into account serving markets well as pricing it well, then it's absolutely fine. And I think the reason why it's important is that actually prime lending can become incredibly competitive.
I was about to say,
to the point whereby it's riskier than other markets.
Or at least in risk-adjusted terms.
In risk-adjusted returns.
Yeah.
So it's important for a business that's scaling and wants to be through the cycle and all sorts of things like that to learn how to do different types of lending. Yeah. So I think it's important skill set for everybody to learn that, because if you just huddle into the prime, you'll find that it can be risk-adjusted returns. There's less margin, and therefore it's actually riskier.
Did you? I mean, I exactly picked that point. I was busily online recently. I was having a look at how much it would cost me. I thought I'd seen a bond that was coming out that paid me 5.5% over the next 7 years, and I thought, what could I borrow? And I found I could borrow from an aforementioned supermarket bank that begins with Marks and ends with Spencer. I could borrow for 7 years at 2.8%. Yeah, and I thought, bloody hell, I could do a carry trade there. But what that made me realise, to Ridian's point, that's super cheap. How are they making any money on that? Isn't prime actually potentially dangerous?
Well, I mean, Zopa from the onset has always been very focused on the prime end of the market, right? Lending to low-risk customers. Also because we were kind of starting on that journey.
It makes sense to start.
Wanted to make sure that investors were on board with the risk that they were taking as well. But also, as we, launched the bank, later this year for us, and as we launched the credit card product specifically, that's an area for us where we will be able to serve customers where historically we would have declined them.
So that's credit card is going to be quite focused there.
Exactly, and the reason for that is because we can lend much smaller amount, see how the customer repays, the credit line that we've been given them, and then through things like a credit score as well that we will provide alongside it, help the customer manage credit well, so that eventually we offer them, a 2.8, 2.9% APR loan, right? So our goal through that product is to lend very sensibly, but one step at a time, make sure that the customer can handle that level of credit.
Really quickly.
Well, it's just interesting that, to use your example, you are anticipating servicing higher risk borrowers by virtue of a bank license, as opposed to being able to do it in a peer-to-peer environment, which is counterintuitive to everything, all the other narratives. So it's worth just sort of stepping through the logic of how it requires a banking license to go into.
Yeah, that's an interesting question.
I mean, on this, absolutely, it's a fair comment. So I think it's specifically on the credit card product, right? Because a revolving credit line through peer-to-peer product is a bit more complicated. Historically, you could have done it through securitization, right, where you would have institutional capital, funding those credit card receivables. But as we know, the securitization markets are great until they aren't, right? And that's why having a deposit base to fund that credit card product for us, we felt, was essential.
I just want to pick up, James. Also, I've got a sort of view. One underserved market as well, from an investor point of view, is you talk about scale up, which brings very nicely. A lot of investors, when I talk to them, complain in crowdfunding equity, they get to invest in too many businesses that are too young. Yeah. And in fact, there's a big market out there for businesses that may be like 3, 4, 5 years away, or even 1, 2 years away from the trade sale, from the IPO. And there's been a real complaint. Look, all the investors business I'm invested, they don't make a profit, and they're not, they're not at scale. Now that market's not terrifically well served from an investor point of view. I'm an old-fashioned investor invested in small cap shares, and there's not many of them listing on the stock market at the moment. A few of them, but not many. Do you think you'll be able to serve that market? Is that a market you think is underserved?
Yeah, totally. Can I just one thing just on this before?
Yeah, please do. Let's come back to that.
I mean, fintech cannot be seen as an easy place for banks to dump risk, right? Because if all that you talk about subprime. What cannot happen in the market is that it's seen that startup sort of challenger companies are the place where people just offload credit risk and onto unsavvy investors. That's what I'm concerned about, and that's part of the reason why we operate the way that we do. But
do you think there's a risk of people doing that?
I think there's been a perceived risk. These guys focus on slightly more prime type of assets, but I think the banks have very clearly wanted to step out from a particular part of the market. And it cannot be seen that these models that are emerging now are just the place that those credits that should never have been funded in the past actually get funding. I mean, we haven't been through. I mean, I don't want to get onto this right now, but we've never been through a proper cycle like we've seen in previous recessions. And I know these guys will say that their models are completely watertight, but that's never been challenged yet. So I think that'll be an interesting thing to see in the next, I don't know, whenever the next cycle happens.
Just want to come back to that.
Yeah, no, absolutely. Because I mean, I think I don't think there is a. I think the cycle point is something that we can, until one's been through a cycle, I don't think there's any ability to persuade people that we're in a good enough shape to do so. And I think that's a perfectly rational human response, which is that you have to, people require evidence as opposed to kind of clever answers, if you like, because I'm sure we all have our answers. And then with regard to dumping risk, I mean, the objective must be for the big lending platforms that are emerging in peer-to-peer lending to become so competitive for different reasons that they do not end up in the sort of the back of the queue and to become the lender of last resort and all of those things that we've probably had to face for 6, 7, 8 years as we built the businesses, unquestionably, because it has to be the sort of platforms of choice for borrowers, or at least as competitive. And I think that there are good reasons why we can get there. So I think even if it's how we've had to get to this point is to be very picky and careful, because we definitely subject to negative selection. And I think going forward, we have to aspire to being able to compete head-to-head with banks. And actually, there are emerging examples of how these platforms are able to do so. So I think I agree that this can't just be the dumping ground, but I don't think it's going to become so.
Well, although the question is, if you looked at, for instance, an adjacent market, which is the robo-advice market, the robo-advice market has got plenty of banks that are entering into that market with effectively low-cost products, where they're using it as not a dumping ground, but they're using it as a place to make sure that their lower value customers can be served, which does tell you something maybe about the psychology of using fintech as effectively a lower cost service platform, certainly, but it might also be a platform where you just have poorer customers. That might, because they just don't have the money in the robo terms. I just want to
that is an example where not necessarily just fintech, but technology is improving access to financial services. Completely. It's just changing the economics of distribution so that you can get to people much easier.
Talking about technology, do we think that the open banking standards and PSD2 will also help open up access? Because I can assure there's lots of people out there, it's underserved, who are thinking, thank God for open banking and PSD2. It's going to come and save my day. Rod?
Ultimately, it's got to help.
Do we think it will help much, though?
Ultimately, I think it will help.
Yeah.
It will help, of course. And if you just go back to the mortgage, in the not too distant future, we'll be able to verify information provided on an application instantaneously. So it makes the process less, creates less friction for the process. I think it will take a while to get there.
Yeah.
And it is chipping away at the edges. That's one part of the mortgage process which has friction, but there's a whole raft of other things which mean it takes 3 months, not just verifying of the banking data.
And I wanted just to pick up on the property side of the fence, actually, because there's been a few startups in the kind of property mortgage area, because it is such a painful process.
Yeah.
I mean, let's be honest, we could go online and get a loan pretty quickly in minutes now, and it's great. It might have its downsides if there's too much borrowing, but it's great, isn't it? But mortgage is just, it's awful. I mean, it's terrible. I mean, how will these new standards help you really speed? Where do you think we'll get to?
So the open banking will help part of that process.
Yeah.
So it helps verification of information, which is a small part of the process.
Yes.
But a lot of the big frictions will remain. So unfortunately, with property, it takes someone to actually go to the property.
Can't really avoid that.
Do a valuation, which you can avoid with automated valuations, which work very well for very standard property.
Okay,
but not all property.
Not all property.
And certainly not for the more active property that we lend to for bridging and development. Doesn't work very well at all. And the other part of the process that needs a huge amount of work is the conveyancing process itself.
Yeah.
That's an area where everyone's got to put their heads together and work out how we create a less frictionless process, because ultimately that's one of the areas that we continue to struggle with as a lender. Whilst we can lend in less than 2 weeks, we're still at the mercy of a dated conveyancing process.
Would you think PSD and open banking standards will help?
Yeah, absolutely. So I think it kind of helps on two fronts. One that we just talked about, which is the whole kind of credit affordability angle, which is not to be ignored, right? Because as we get more data, about the customer, that means all underwriting decisions, can be even better. But the other angle as well is, as people connect their bank account and other financial services to us, is that we are then able to make, recommendations about what are the best products for them given their circumstances. Because oftentimes I think, the right product might exist out there for the customer, but they do not necessarily realize that there would be.
Sure, that's very common.
Exactly, or that they could realize, big savings if they were, replacing this credit card product that they have with our own. So I think you will see. Obviously, it will take time because it's also we need to gain the customer trust. It's a big deal for them to, give us their bank credentials. But as they do that, I believe that we'll be able to make, smarter recommendations to customers once we start, realizing those savings for them. Hopefully, they talk about it, with their friends, family, etc., and see some virality kicking in.
Just quickly, and then we'll go to the questions, really.
Yeah, no, I was just going to come back to the original question about underserved, because I think underserved is there's 2 million people or something like that in this country without a bank account.
Yeah, absolutely.
Unbelievable, which is really quite striking. And I think it comes back, thinking about it, like the current account is the key capture for a bank, and then they cross-sell lots of products that we probably compete on. But I think that if you unbundle all of that and created kind of just a basic bank account and charged for it, then every customer could become profitable or viable. Whereas the issue is that there's just a whole host of customers that are just not viable for a bank to take on at the current account level. And therefore, that's where the exclusion probably takes place.
A good example of that, I did work ages and ages ago for HSBC, and they launched a basic bank account to exactly target that market. But I think they found, and it was an attempt to do a simplified product, exactly as you said, that the exclusion factors are quite often to do with technology, access to branches, geographical access to branches, all sorts of practical issues that just get in the way of it.
Which should be mitigated by today's
technology.
So maybe... There's
a couple of questions. Are any of the platforms here considering opting for the EU crowdfunding services provider license with ESMA under the new EU CFS? There's a lot of acronyms in there. Regulation becoming effective. Simon, are you going for the crowdfunding license across Europe?
We're MiFID firm. We've got a European passport. We'll see how that pans out. But no.
No, short answer. Next question. Talking about exclusion, we talk about the UK market, but it's good question this. A lot of successful alternative finance lenders aren't present in smaller markets like Ireland. That's a really good question. And Denmark. Doesn't there need to be a certain amount of scale? Why aren't the banks are there? Why aren't you there? It is actually a good question. I know there's obviously jurisdictional issues, all that kind of stuff. We realise that. But actually, a British operator should probably be able to operate somewhere like Ireland. It's very similar kind of cultural constraints. There are lots of other smaller markets where you guys, I know Zopa in the past have opened up in different parts. We had an Italian business as well. You've got an Australian business. I mean, what about these smaller businesses throughout Europe? I mean, surely there might be some opportunities there.
So we've looked at other markets across Europe, particularly looked at Ireland.
Makes sense.
But we're a relatively small business, and we've got lots of growing left to do in the UK. And we took the view that actually, if we focused on originating more loans in Manchester, within one legal jurisdiction, we'd probably get the same impact as we had by moving and setting up a whole infrastructure in another country. Ultimately, we'd love to do it, just not just yet.
I think credit reference agency infrastructure is absolutely key on the consumer side, and I think it's not as developed in Ireland as it is in the UK. So,
though it's also an area where, as PSD2 is coming into force across Europe, you could see actually markets that were very difficult to penetrate might become targetable by new fintech players, because thus far you had quite poor credit referencing data. But if the customer is willing to link up their bank account, then you might see more competition in places like France, Germany, etc. For Zopa's specific case, we are very focused again on the UK at this very stage. As I said, the market is about 200 billion, the one that we are targeting. So we would rather do well there and then see where we want to.
One very last question. This is actually a very interesting question. As you improve access, you open up the possibility, effectively, with the wrong kind of money. Sorry, guys, you're all having to look at the screen back there. Apologies, but Didier and Rudian got the worst job. Given the current news cycle, how do you keep dirty money off your platforms? And in a sense, what that's opening is the wider question, which is, as you improve access and make the technology better and you make it more streamlined and all those factors, you do invite the problem that you end up with the wrong kind of money emerging on, because you're trying to make everything so. I know we all know you've got to go for the AML procedures and all that kind of stuff. You can't avoid all of that. We know that. But there is a trade-off here, isn't there, which is making things easier does basically mean you open yourself up for operational risk.
Yeah, I don't think it's easier to invest in a platform than it is to, one of these new businesses, well, they're not news, some of them now, as it is to open up a stockbroking account or so forth. And we've reached the same standard, I think. Yeah, I think there's actually a bigger philosophical question right at the top in terms of AML, in terms of really, is it being fought in the right way? Because all the responsibilities trickle down to every single firm to do the same checks on the same people, and it's a bit of a merry-go-round. And really, should it not be sort of one version of the truth and monitored that way round? Because the crime, and also that would probably free up more time to actually focus on the crime as opposed to the the layering of the proceeds. But so I think there's actually, I expect that whole AML piece to come under serious scrutiny and lots of change to happen there, because it's completely unworkable in a lot of cases and very inefficient for a lot of human endeavour for very little output. And probably if they reimagined it in a fintech world, they probably could, whoever they are, could come up with something much more efficient. And I think government have bought into that concept. One
very last question. Going back to something Ridhya mentioned, actually. There are millions of people without bank accounts in the UK, so the true underserved market, who are financially excluded. What's the one simple thing that you think could allow better access to that market?
Charge for current accounts.
Yeah.
It's true that, I mean, coming from Europe, we are used to paying for current account. It's true that in the UK, where you have kind of free and credit, but all the other people kind of cross-subsidizing, is making it quite difficult for those people.
Very interesting. Okay, we've run out of time. Put your hands together for this panel. Thank you very much, gentlemen.